Pankaj Murarka of Renaissance Investment Managers into this conversation as well. Pankaj, thank you so much for talking to us. We are speaking to Dinshaw Irani. He seems constructive from where we are right now. He believes this is the start of something new. Do you concur? Do you second that? Or do you differ?
Morning, Neeraj. No, I certainly believe that I think markets have bottomed out in that sense. Markets were in a corrective phase, but I think probably looks like that's behind us. And it was a very much needed stimulus. So I still see markets building upon gains from here on towards till the end of the year. But having said that, the fact is that the economy has been very weak, as we have been seeing in the corporate numbers this quarter and the last quarter as well. There was clearly a lack of demand momentum in the economy, and the growth momentum has decelerated significantly. So I think it was much needed in terms of what this GST rationalization and tax cuts would do, and cumulatively combined with the tax cuts which the government has done in the budget, this amounts to almost like about 60 basis points of GDP as fiscal stimulus that's been thrown into the economy or pumped into the economy. And on top of that, we've had 100 basis points of rate cuts from RBI, which effectively is about 40 odd basis points of GDP in terms of savings on EMIs for home loans or car loans or everything. So sum total of it, we've had a combination of fiscal and monetary stimulus of almost 1% of GDP, $40 billion, which is very significant, and I think it will help in revival in demand and in growth recovery in the economy.
Okay, Pankaj, hi, Tamanna here. What is the shining star over here? So far, IT is sitting out. IT sector is sitting out, but that is also now up in the green. Banks are completely roaring. It's all about auto and EMS. Where are the opportunities that you're seeing to play on this theme even further? I think people are not realizing what a big impact it's going to have to reduce these rates. You're going to see at least 90% of what was in the 12% bracket of GST go down to 5%. That's a massive consumption boost, isn't it?
Absolutely, Tamanya, I would agree with you. I would still think, we like banks because that's one sector where valuations, I've been making this point, are at discount to the Nifty index. And large banks have pretty healthy balance sheet, and they should be a beneficiary as we see, second order beneficiary as we see revival in consumption, whether it autos or consumer durables. Eventually the banks will be the ones who will be funding that. But I still think that it's a good idea to buy into consumption names, both staples and discretionary, because we are coming out of a very sharp 2 years of slowdown in consumption in the Indian economy. And I've been making this point that if you look at India's aggregate consumption, the private final consumption expenditure, the long-term growth rate for that has been in line with nominal GDP at about 11%. But last 2 years, our aggregate consumption has grown at about 5.5%, so half of the long-term rate. And my experience tells me that when we have such sharp compression or slowdown in consumption, it eventually rebounds and catches up with the mean growth rate. So, which is what I'm expecting, a revival in consumption. And all of this fiscal and monetary stimulus will aid in the process. So I still think that, consumer as a sector has underperformed in the last 2 years, and there has been a slowdown in consumption. Now, all of this stimulus should help demand recovery, and valuation in the sector are very much in line with long-term averages. So I would still buy into consumer names both across staples and discretionary.
Pankaj Murarka, how would you play this GST Diwali gift?
I think, as I said, we continue to like financials, and within financials, we like the larger banks versus the smaller ones, because we think larger banks have been eating into market share of smaller banks, and they will continue to expand their dominance, so they will grow faster than the industry growth. And as I said, there's a very large value comfort with larger banks, and valuations are very reasonable in the context of long-term valuations where they are. But I would still play consumers. I will go and buy into consumption. I'm once again making this point. We're coming out of a very low cycle of consumption of 2 years of slowdown. So from here on, given the kind of stimulus that has been injected into the economy, both fiscal and monetary, I think we will see a meaningful recovery in consumption. And when you have a consumption recovery cycle ahead of you, you cannot not buy consumption. Okay. Apart from that, I take Dinshaw's point that where we like platform companies in terms of Swiggy and Zomato, we like internet as a sector. I think that's one sector which will continue to grow at probably high 20s, 30s over the next 5 to 10 years. So that's a more secular play rather than a cyclical revival of consumption. And I would think these would be some of the plays.
Wow.